Geopolitical tensions in the Middle East seem to be increasing with the hour. Now, seeing energy and infrastructure sites being attacked. Given the region's energy resources, these tensions could cause oil to rip higher. With the US already in a precarious fiscal situation, could this be the straw that breaks the bond market's back? So, here, over the past 24 hours or so, we have seen the escalation of attacks over in the Middle East between Iran and Israel. Each country has now targeted at least one of their enemies' energy resources, whether it be a refinery, a storage depot, that sort of thing. So it appears that those kind of infrastructure and economic attacks, kinetic attacks on economic infrastructure, seem to have started. And generally speaking, I'm no geopolitical expert, but generally, those will continue. As the war unfortunately drags on. My hope is that this can get ended, but we are where we are. So, why does this matter for the bond market? We did a video talking about the bond market actually, but approached it from a different sort of perspective. That last video we did, and go check it out. It's pretty, I think, pretty interesting dynamic, which is the creditor nations of the U.S. are also net energy importers, meaning they're short energy, meaning as the price of oil spikes, it puts them into a current account deficit. They have accumulated huge trillions of savings, right? National savings, due to running current account surpluses. And one of the ways that you can fund a current account deficit, if you are one of those creditor nations, is by selling the savings that you have accumulated, and those are U.S. Treasuries. That can cause, right, that is one way that rates could move higher. Well, here's another way. So and you add the two of them together, and it's not the best picture for the U.S. So here's nominal growth, inflation plus real GDP. Then we have three different bond yields here: the 5-year, 10-year, 30-year, in these different colors. Generally, what you can see is that over the past 30 years or so, nominal growth has been higher than the cost of the debt. This is okay for the government. They can sustain that. That is not generally a crisis of any kind if you can keep nominal growth above the cost of the debt. Well, the problem, as we've been pointing out in many, many videos, is that the cost of the debt has been rising over the past 4 or 5 years. Meanwhile, nominal growth has been falling for the past 4 or 5 years. Now, a lot of that is normalization due to kind of the extremes that we saw in 2020, 2021. But in general, that trend would be worrying, where you have nominal growth falling. And in fact, right now, the 10-year yield is just barely above nominal growth, and the 30 and the 20-year yield are significantly above nominal growth. Everywhere on the curve is above the current average weighted interest rate on US debt, total marketable debt. That average interest rate is 3.3. Even if we issued at the lowest yield, which is the 2-year yield, that is at 395. Meaning, what that means is that interest expense, as more and more debt needs to get rolled, interest expense will only move higher. Well, how do we pay interest expense? We issue more debt, new debt. That is an increase in the deficit. That is increased bond supply, right? You can hopefully see how this can become kind of a self-perpetuating cycle that moves rates higher in the face of higher bond supply. And the effect of a rising oil price can have a very negative effect on growth. So here is GDP on a quarter over quarter basis, and then the price of WTI. And the red shaded areas are NBER, National Bureau of Economic Research. This is the official recession organization that defines official U.S. recessions. You can see here that when the price of oil moves higher, this might not look like much now in the late 90s, but this was a significant move in the late 90s. Oil breaking out to like $34 per barrel. You can see what happened to GDP. GDP, as oil moved higher, real GDP moved down. Remember, this is inflation adjusted real growth. Same thing is true here, right? Leading into 2008, As oil moved higher, we can see the effect that real GDP had. Anything below this red horizontal line means negative GDP, meaning you had a quarter where the economy shrank. And sure enough, we just had one of those, very ever so slightly, but we had a print of negative GDP last quarter. And one of the things you might be thinking, because there is a recent example of oil spiking higher. Here you can see even this kind of minor move in 2017, 2018, real GDP fell almost to zero. Well, we had the spike in 2022 where oil went from like 90 to $120 a barrel because of geopolitical tensions in Europe. And what effect did that have on growth? Well, we can see real growth was already falling. The growth rate of the U.S. economy, inflation adjusted, was already falling. But we actually did get 2 quarters of negative GDP growth in the last administration. There's a whole bunch of argument whether they changed the definition of recession. FINRA, at least when I was studying for the SIE with FINRA defined a recession as 2 consecutive quarters of negative GDP, but it kind of became a whole political issue, and no recession was actually declared, because I think their reasoning was unemployment rate remained relatively low or is actually continuing to fall. I think that was their explanation. But that spike in oil prices in the past couple years, past 5 or 6 years, it did cause real GDP to actually have 2 consecutive quarters of negative growth. That has traditionally been the definition of a recession. Like I said, there was kind of a whole political thing that became of it, unfortunately. But the effect of oil, right? Oil is not just energy. Energy is super important in terms of global kind of economic output. But remember, oil also is an input for lots and lots of kind of essential products, right? Plastics, petroleum products. Petroleum, or goes into a huge amount of kind of consumer goods and even durable goods. Oil is not just critical as an energy unit, but also for all of the other uses of petroleum. And so, when the price of those inputs goes up or that energy goes up, the fact that growth slows, hopefully that makes sense. Here's WTI oil and CPI on a year over year change. And hopefully the correlation here is very, very clear. CPI lags the price of oil by just a couple months. Here we can see that oil set a bottom in February of '09. CPI set its bottom in July of '09. But in general, there's only a couple month lag, and then inflation basically follows the price of oil. Well, one of the ways we can see how tight this correlation is to run a correlation coefficient. Here is a correlation coefficient. Anything that goes where these bars go negative, that indicates a negative correlation. What that would mean: oil moving higher, CPI moving lower, right? Opposite directions. But instead, what we see is, especially recently, especially in recent history, we can see a very, very strong correlation, positive correlation between the price of oil and CPI. I would say it's pretty safe to say that this has remained over zero point 0.6 for much of the recent, past few decades. 0.6, 0.7, that is a very strong correlation. Here is CPI on a month over month basis and the price of oil. And you can see that the price of oil, when the price of oil, moves notably higher, like it did here in 1990, again, on a month over month basis, you can see that CPI moves higher. And remember, when the Fed is looking at this particular metric, I always say be careful not to annualize out a month over month metric, because as you can see, there is a lot of noise. Well, that being said, just psychologically, if you're the Federal Reserve and inflation has become this huge kind of crisis in America, uh, you don't want to see a situation where you're printing over 1% on a month over month basis on CPI. That sort of change, if oil spikes and this month over month number goes from 0.1, 0.2 up to 1, If you annualize that out, even though you shouldn't generally do that, it's hard not to, right? When you see inflation is moving higher at a rate of 1% per month, if you're the Federal Reserve and faced massive criticism for your handling of inflation, in 2021 and 2022, if you're them, you're scarred psychologically from all the criticism that came at them for being too late to start kind of addressing inflation. I think that that influences their mindset, and you can see that there are these spikes in oil prices that cause month over month inflation to move as high as like 1.4%. That's like 13.5% annualized inflation. Even here, 1% annualized inflation right before '08. Here in 2022, it was like 1.2%. If you annualize that out, even though you shouldn't, that's high inflation rate. And so I think that even though they kind of know better not to annualize out month over month data, just given the context, given the kind of the political context, right, or however you want to phrase it, where they were so widely criticized and took so much heat for kind of lagging, right? They called inflation transitory, famously, right? They were kind of very, very wrong on inflation initially. And I think that, they took a lot of heat for that. And I think that should you get a month over month print that's moving, notably higher above zero point 0.5, zero point 0.6, that could kind of scare them, just given the kind of overall context that we just described. So here's the 10-year yield and WTI in white. And again, I kind of want to point out the correlation. So we established that oil and inflation. This is the negative effect. So it has a negative effect on real growth, has a positive effect on inflation. Right, that's starting to become very stagflationary. And the other effect here is with the 10-year. So one of the ways that we can kind of look at this, remember the 10-year is supposed to approximate nominal growth. And what you can see is that oil hit its peak in May of 2022 at about $120 per barrel. This was during the last kind of geopolitical round of tensions. Well, the 10-year yield at that time was about 3%, and now it's 4.4. So the 10-year yield has moved 140 basis points higher since the peak in oil prices here in 2022. But if you look at the price of oil, even though they are very tightly correlated, I mean, just look, right? 10-year yield set a high here in 2018. Oil set its high right there, right? And then they moved down in tandem. Same thing is true going the other direction, right? Oil set a bottom here, moved higher with the 10-year yield during this period of time. But what we've seen is kind of a divergence where you see, the 10-year yield is moving higher, but oil is moving lower. I do think it's kind of breaking out currently, and it'll be interesting to see where futures open up in a couple hours, given the escalations recently. I do think oil is breaking out to the upside, but the question then becomes, okay, if rates were already moving higher despite falling oil prices, and this is mainly due to, in my opinion, to term premium or the expansion of the premium that is being demanded to hold longer term bonds. We can see that here in the purple line. So here, this purple line shows term premium. It shows the 10-year yield minus the 10-year break-even inflation rate. And you can see the shape of this, the term premium, or excuse me, the real yield over inflation, some of which is term premium, has moved higher. Right, we had negative real rates here, down to as low as -1%, and those have moved higher, and in fact are now above 2%. So if you buy the 10-year bond right now, you are getting 2% above inflation. That is what that indicates. I think the fiscal concerns, the fact that we've been running kind of utterly insane deficits for 4 years, and it looks like they're only going to get worse, right? It is logical for bond yields to move higher, even if oil is moving lower. And we know inflation has also been moving lower. As we can see here, right, in purple, you can see inflation has been moving lower, and in fact has been moving kind of notably lower over the past 6 months or so. Despite that, you have the 10-year yield moving higher. One of the main reasons it would do this is due to an expansion of the real yield. And this is the premium over inflation that the bond market is demanding. Some of that is term premium. Term premium right now is, I think, like 55 basis points of, and so the context for a rising oil price here is already kind of this bad, if you're the government, this horrible divergence where rates have been moving against you, moving higher, as oil has been moving lower, as CPI inflation has been moving lower. You have 10-year and especially the 30-year moving higher. So you get into a situation where if oil spikes, not only does inflation spike, but it has a negative effect on real growth. Um, but you would get, a higher 10-year yield. This shows the correlation coefficient between the price of oil and the 10-year yield. And while it's not as high as CPI, it is pretty high. Going back to kind of the post GFC world, it is a pretty significant positive correlation. And generally, right, when you are in a recession is when you see that negative correlation hit. Not every time, right? It's possible to have a negative correlation without a recession, as we can see during this period of time here in the early 2000s, as well as this very slight negative correlation in 2012. But in general, this is a positive correlation. So if oil moves higher, you get a 10-year yield moving higher. Well, I tried to kind of think, how much could this possibly happen? Um, and I went back and looked at the kind of last geopolitical tension. And I understand there's a ton of variables here. Ukraine is not equivalent to, Middle East. I would argue that the Middle East is even more important in terms of the price of oil. Something like 25% of all oil it transits through the Strait of Hormuz, which is, Iran just a couple hours ago was one of their politicians, ministers was talking about potentially closing that. Well, you just took off 25% of the world's supply of oil if they were to do that. So I would argue that it's actually even more pronounced, the effect that this could have. I think JP Morgan Chase is predicting if things continue to escalate, you could see oil move to $120 a barrel, which is much more significant now, given the fact that like that move is significant because we are coming from a lower level. And I will show that in a minute. But in 2022, the last tension, right? Oil went from about $90 a barrel to $120 a barrel. Set that here in June of 2022, as well as March of 2022. It got up to that $120 level. During this period of time, it increased by about $30. The 10-year yield increased by 140 basis points. That's 1.4%. Well, remember, this was also during a time of inflation and Fed hikes. So the Fed had hiked rates by 75 basis points in this period of time. Now, it's quite possible the Fed would hike again, like I said, going to the earlier point of them being scarred from kind of fumbling inflation the first time around during this period of time, right? They were so widely criticized, they're so kind of scarred from that. They may be pretty quick, they may bias towards hiking rates to avoid another kind of widespread outrage at inflation. They may be more inclined to fight inflation by raising rates. So, but even if they don't, even if they do not, one way to look at this, right, is okay, if the 10-year yield moved higher by 140 basis points on $30 oil price move from $90 to about $120, which is when I'm measuring this particular period of time. If a $30 move in oil caused a 140 basis point move in the 10-year, even if you subtract out the cuts, that still is 65 basis points on top of the 10-year. So remember that number. Now we're going to fast forward to the present day here. And what I think makes this more noteworthy is that the price of oil is coming from a lower level. So here in red, again, is oil. I mean, before all this kicked off, oil was trading in the mid 60s. So $120 barrel oil, which is what some of the big financial firms are predicting, that is a doubling, right? Going from 90 to 120, as it did in 2022, going from 90 to 120, that is not a doubling. That is nowhere close to a doubling. It's still a significant move, but it's not a doubling. With this conflict going from 65 to 120, that is basically like a 95% move in the price of oil. So if that were to happen, and you were to, even if you were to have Fed rates remain constant, if you add 65 basis points, and again, this is assuming the Fed isn't scarred. This is assuming the Fed isn't biased towards hiking rates to fight inflation. That 65 basis points on top of the 10-year now, that's over 5% on the 10-year. Now, does that break things? I don't know. No one really knows. A lot of people seem to think 5% is where things start to break. Again, if the bond market becomes worried that okay, our deficit starting point is an utterly insane 6.5% of GDP deficit, if this spike in oil prices causes a recession, like it has many times in the past, oh no, now the deficit as a share of GDP is like 15, 16, 17, 18% of GDP. And given all the concerns with the fiscal health of the US, bond yields could actually go up. If oil spikes, and this is what I've been saying for a year and a half, I was kind of widely mocked when I first started talking about it, but now you have people like Jeffrey Goonlock saying the exact same thing. So, I think I was onto something. In the next recession, you could have rates move higher, not lower. People would not go buy bonds in the face of the next recession. They would look at the deficit as, 15, 16, 17, 18% of GDP and go, yeah, there's no, I'm not buying bonds when the bond supply is when the deficit is that large. There's no way, right? You sell bonds, you short bonds. And you get into a self kind of perpetuating cycle where rates move higher, deficit moves higher, growth is moving lower because you're in a recession, GDP is moving lower because you're in a recession. As the deficit moves higher, higher deficit means more bond issuance, more bond issuance, more bond supply in the face of constant demand or even falling demand means higher rates. Higher rates drive up interest expense. Higher interest expense drives up the deficit, right? Hopefully, you can see how that can become, a very, very bad situation for the government. So again, even if you were to just kind of transpose the situation in 2022 onto kind of current time, even though the move in oil that people are predicting would be a more significant move than what happened in 2022, this would be about 100% move, whereas that was, I don't know, 50, 60%. Even if you just transpose kind of this scenario with a constant federal funds rate, that takes the 10-year to over 5%. And again, no one really knows where the danger level is. But a lot of people sure seem to be talking about that 5% level. And so in my opinion, this increases. I think that the people within the administration that are halfway intelligent, like Scott Bessent, I think people like him understand these dynamics, and Stephen Myron understand these dynamics and understand that this would be very, very bad, especially given that this current administration just politically was kind of one of the major reasons they were elected was inflation. You can't have oil ripping to $120 a barrel, doubling basically in a couple weeks, right? You can't have a doubling. Their one of their primary goals was bringing oil down, which they did up until recently, right? So I think they have a huge incentive to not allow this to escalate and to try to end this conflict. Because if it continues to escalate, you have $120 barrel oil, you have inflation moving higher, you have real growth moving lower, you have the cost of the debt moving above nominal growth, you have a potential recession, as spiking oil has done in the past, where GDP falls and deficit increases. Now you're talking about a 15, 16, 17% GDP deficit that, drives the nominal deficit higher. The way we fund that is more bond supply that drives rates higher. That interest from those the higher interest expense is funded by increasing the deficit. You run a larger deficit to cover the interest expense now with higher rates, right? And it becomes like this self-perpetuating cycle. It is basically everything that the government can't afford to let happen. And if you're interested, I did a video called "Why the U.S. Cannot Afford a Recession." I think like a month ago. It's very similar to the concept I'm trying to describe today. So yeah, just something to kind of bear in mind. Um, I'm not sure where all this goes. I'm not a geopolitical expert. I try my best to stay informed of what's going on, but I'm certainly not a geopolitical expert. If you believe that this is all nothing, the Middle Eastern issues all nothing, then none of this really matters, right? And we can go back to talking about the same old stuff we were a week ago. But if you believe that it will at least stay kind of constant, if not escalate, then the price of oil could be moving meaningfully higher, pushing down real growth, pushing down GDP, pushing up on inflation, pushing up on yields at the same time, the same year we're trying to roll 9 trillion in debt. If the Fed has to hike this yellow line, right? Again, they are probably biased towards hiking in the face of a 1% month over month CPI. They are probably biased towards hiking rates. If they do that, remember how much of our debt is issued at the short end. That also increases interest expense. I think long-term rates would move even higher. I think the 30-year could go to like 550, or even higher. But even if it's just the short-term rates, that is where a lot of our debt is issued. So if the Fed hikes by 25, 50 basis points because they're scarred from the last kind of inflationary wave, that also drives up. Remember, the current average cost on our debt is 3.3%. There's nowhere on the curve that is lower than 4%. So no matter what, interest expense is already going to go up. The way we pay that interest expense is via the deficit, increasing the deficit, issuing more debt. More debt, more bond supply, constant demand, or even falling demand due to the international dynamics of a weakening dollar, right? Like this could very easily get out of control, in my opinion. And so I think, other than watching the oil price, keep a very close eye on 10-year treasury rates, right? I think that the bond yield could signal, this will start to get priced in. The likelihood of all these dynamics I just described, that'll start to get priced in by the bond market. And by the way, sure enough, what we saw in the 10-year bond yield, it moved, meaning we had that strong auction here, right, that we covered. But then on Friday, the 10-year bond yield moved meaningfully higher. I think it was up like 8 basis points that day. So again, keep an eye on the bond market, keep an eye on the price of oil. It cannot be understated just how important all of this is, to not only inflation, but nominal growth, real GDP. Clearly, the effect on inflation is hopefully very easy to see and to conceptualize. We can see that very positive correlation there. It would have a negative effect on real GDP, as we covered here, and with rates already biased towards the upside, even with falling oil. And again, this is due to the real yield moving higher, as we can see in purple here. If real yields continue to move higher, if term premium continues to move higher, you have a situation where rates move even higher than this, up to, you add 65 basis points. Arguably, the situation would be even worse than 2022. Even if the Fed doesn't hike rates, you could have the 10-year hit 5%. If the Fed started to hike rates, you could be talking about a 5.2, 5.3, 5.4% 10-year yield. So yeah, it could get out of hand. And so my hope is that the administration understands how catastrophic this would be, and so will work really hard to end this conflict. I don't really have faith in politicians, so I will just kind of continue to hope for that. But the likelihood of it seems pretty small, at least here on Sunday at 11:45 a.m. Pacific time. Anyways, hopefully that was interesting and helpful, and I will catch you on the next one.